You've got $18,000 in a duffel bag, and the first rules sound stupid. Never deposit more than $9,900. Why? Banks file a currency transaction report on any cash deposit over $10,000. Automatic. No vibes required. So people split the bag. 2 branches. 2 days. Congrats, you just invented structuring. And structuring is already a federal crime, even if the cash was totally fine. Spoiler, the software is watching the pattern, not your excuses. Here's the plot twist nobody puts on TikTok crime tutorials. Banks don't only watch the 10,000 line. They watch deposits suspiciously clustered just under it. Same face, same amount, different branches, same week. A teller doesn't need a math degree. She needs a pattern that screams, I am dodging a form. Then comes the SAR, Suspicious Activity Report. No proof required. Just, this looks engineered. Most small-time laundry dies right here. Money is in the bank, and nowhere near clean. Level 2, the cash business. You buy a laundromat, not because you love detergent. Because cash businesses are the OG blender. Real quarters in. Dirty cash rides along. If the store takes 4,000 legit, you report 6. Pay tax on the inflated number. Feels backwards until you realize taxed fake income is still the costume dirty money wants. Auditors can't easily disprove cash revenue without spy movie surveillance. Nail salon, car wash, vending route. Same energy, same disguise. But scale has a boss fight. You can only hide roughly what the business could plausibly earn. When dirty money outgrows the storefront, the math gets spicy. Investigators love a simple reverse check. Water, electricity, detergent purchases versus reported revenue. Claiming $6,000 in laundry, while buying supplies for a sad half-load. That's not entrepreneurship. That's a mismatch that turns a boring tax audit into a financial crimes referral. The universe keeps receipts. Literally. Level 3. Shell companies and fake invoices. When the laundromat can't absorb volume, you need companies with 0 customers and infinite paperwork. A shell exists on paper, state registration, mailbox, HQ, vibes of legitimacy. It invoices your legit business for consulting that never happened. Legit business pays. Money moves from a place that must explain income to a place that never has to prove work. On paper, everything looks professional. In reality, it's laundering cosplay with letterhead. That hop is called layering, moving money through transactions designed to break the trail. 1 fake invoice looks like normal spending. 20 invoices through 6 shells across 3 states? That's a conspiracy board waiting for string. The catch: investigators often ignore the pretty invoice and hunt the connective tissue. Same mailbox, same accountant, same formation agent. The fingerprint is the network, not the single PDF. Your paperwork can be clean while your structure is screaming. Level 4. Real estate. Property values are subjective, and subjectivity is a VIP lounge for dirty money. Buy a dump for $200,000. Later sell to another shell you control for $500. Instant profit from a legitimate deal. Cash-heavy purchases historically faced softer scrutiny than bank-financed deals. 1 flip can wash hundreds of thousands. Multiple cities, multiple shells, suddenly you're role-playing Monopoly with federal consequences. Real estate agents and title companies sat in an awkward seat. Big money, historically fewer AML questions than a bank teller asking about the same cash. Regulators noticed. Beneficial ownership rules started demanding the actual human behind the shell buyer. Enforcement still varies by city and country. Where rules lag, property stays a favorite large-scale wash. Where rules catch up, the nobody-asked loophole starts closing. Progress is uneven. The method is patient. Level 5. Offshore structures. Domestic banks, property records, and tax agencies share info like group chat gossip. So big money goes shopping for jurisdictions with weak beneficial ownership disclosure. Money enters an offshore account owned by a shell owned by a trust run by a local agent who may never know, or never have to know, who's really behind it. Then hop countries. Each hop adds a legal wall. Investigators need cooperation. Cooperation can take years. Or forever. International pressure got louder. Automatic information exchange, task forces, less patience for secrecy tourism. But opening a new shell in the next, not closed yet jurisdiction is still easier than closing every gap everywhere at once. Leaked offshore document dumps did something regulators struggled to do alone. They showed the whole client list. Same templates, same agents, same infrastructure used for boring tax games and serious crime. One leak, thousands of puzzles unlocked. Level 6. Trade-based laundering. The method regulators call hardest to catch because it hides inside normal commerce. Over-invoice a container of furniture, electronics, textiles, anything with a fuzzy market price. Importer pays the inflated bill. The price gap crosses the border dressed as a trade payment. Under-invoice works reverse. Ship valuable goods cheap on paper, resell at full price, pocket the difference as sales. Customs is built for smuggling and tariffs, not price philosophy debates. Catching this means reconciling invoices, manifests, and customs data across countries. Work most ports can't do for every shipment. Analytics help. Compare declared prices to thousands of similar trades. One weird invoice. Maybe a weird day. A company that lives at the extreme edge of plausibility for years? That's a statistical confession. Pattern beats anecdote. Again, dirty money keeps losing to spreadsheet energy. Level 7. Cryptocurrency mixing. Dirty crypto goes into a tumbler. Comes out mixed with everyone else's pool to a new wallet. On-chain link. Broken, supposedly. Irony alert. The blockchain that enables this also records forever. Forensic tools hunt timing, amounts, clustering across the mixer's entire pool. Some mixers got seized. Their own logs unmixed years of transactions in one rate. The anonymity promise? Temporary. Like a VPN commercial, until the service itself becomes the case file. Beyond mixers, hop exchanges. Leave a heavily regulated KYC exchange. Jump to a weak oversight venue. Cash out through soft screening. Blockchain analytics firms built businesses mapping these hops for law enforcement. Same connective tissue logic as shell networks, just wallet addresses instead of mailbox LLCs. If your plan is crypto makes me invisible forever, history keeps posting rebuttals. Tech changes. Pattern recognition upgrades. The cat and mouse continues, and the mouse keeps leaving breadcrumbs. Level 8. Correspondent banking and complicit, or just porous, institutions. At this scale, single transactions barely matter. Banks process for other banks so money can move globally. Essential for real commerce. Also historically used in some of the biggest laundering cases ever documented. Billions can move for years looking normal inside relationships nobody wants to kill, until a whistleblower or a compliance review finally asks the obvious question. The inside story is often less evil mastermind boardroom and more slow institutional fail. Under-resourced compliance. Thousands of alerts a day. Bonuses that reward volume over flags. A correspondent relationship too profitable or too sensitive to scrutinize until outside pressure arrives. History's biggest banking finds often look, from the inside, like dozens of missed chances to ask one boring question. Conspiracy optional. Neglect is plenty. Level 9. The people who crack it open. Behind almost every major prosecution is a human, not just a paper trail. The accountant who kept the wrong records. The employee skipped for promotion. The registered agent who finally talks. Whistleblower rewards exist because insiders hold maps that years of subpoenas might never fully rebuild from outside. External forensics can take forever. One motivated insider can collapse the maze in a week. Level 10. How it unravels. Dirty money must eventually explain itself to some institution somewhere. Every explanation is a data point that outlives the transaction. Financial intelligence units, like FinCEN, aggregate SARs, CTRs, and wire data into patterns no single bank can see alone. One invoice looks boring. 40 related flags across countries over years. That's the structure finally visible. Cases take years because each step was designed to look unremarkable. until the whole file is one long straight line. Investigators call these cases labor-intensive for a reason. Subpoenas, cross-border legal help, forensic accounting. Every shell, every offshore hop, every mixer is designed to multiply that labor. The system doesn't usually fail because tools can't eventually trace it. It fails when tracing costs more time than politics, statutes, or attrition allow. Dirty money's real strategy isn't magic. It's attrition warfare against attention spans and budgets. Bottom line, dirty money becomes clean by wearing costumes. Banks, businesses, invoices, houses, islands, trade, crypto, banks of banks. Every costume leaves lint. Educational only. Not advice. Not a how-to. Not encouragement. If this rewired how you see money's fake makeovers, comment the next financial rabbit hole you want broken down. I'm Finn from Plain Money. Stay curious. Stay legal. See you next time.